I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, on the IPO front, Pinterest kicks off its roadshow, aiming for a valuation that is less than what it fetched in its last private funding round as the public markets heat up. Plus, Facebook, Instagram, Twitter, and more face heavy fines or even a UK ban under a new law if they don't act fast enough to remove violent and hateful content. And what's so special about Snap? The company's stock has more than doubled in 2019, and now analysts are jumping in on the optimism. But first, to our top story. Pinterest seeking to raise as much as $1.28 billion in its initial public offering. Pinterest setting the price range for its shares at $15 to $17 a piece, which would give it a valuation of about $9 billion, which is less than the $12 billion valuation it raised at during its last private funding round. So, why the conservative pricing? Joining us now, Triton Research CEO Rhett Wallace. Triton is an intelligence platform helping investors understand the companies that are inventing the future. Also with us, Bloomberg Tech's Eric Newcomer. So Eric, I'll start with you. What details are we getting from the roadshow and investor appetite for Pinterest so far?
You know, I think we're still seeing it's early in the process. I think the goal is to price April 17th. But, you know, learning from Lyft, which priced at 72 and then has struggled to sort of maintain that range, you know, I can have a little sympathy for Pinterest to try and set expectations somewhere where it can meet and then sort of exceed them.
Rhett, what are your expectations for Pinterest? Obviously, they're making money. They're losing much less money than Lyft, but growth is slowing.
So we think the comparison to Lyft is interesting, but also the comparison to Snap is kind of interesting too, because the business is kind of identical. And so, you know, Pinterest is almost twice as big as Snap was. Snap was losing more EBITDA than it had in revenue. It had about $500 million of EBITDA losses. And so, what's interesting about Pinterest is it's just a much more mature company, and therefore a much more highly rated company by our rating system than Snap was when it came out. As far as the IPO is concerned, you know, look, Lyft ran a process to find the highest possible price. It seemed that Pinterest is probably running a process to find the right price for long-term shareholders.
But given that the valuation is less than what they raised out in the private rounds, couldn't that lead some investors to scratch their heads and say, why? Why would, a year, 2 years ago, investors be so excited to jump in on this price? And is the company, less great now?
Well, I mean, look, public companies have prices that go up and also go down, and all of those long-term shareholders are going to be locked up for the next 180 days anyway. So they have a long time to find out what the seasoned price is going to be. But I think when you come into the public market without the kind of volatility that Lyft has shown you, you're more likely to find that seasoned price in a happy way rather than in a bumpy way.
Now, Pinterest's business model, as you say, sort of like Snap's in that they're selling advertising from big brands to a large and established audience. Eric, that is very different from Lyft, very different from Uber, but we're sort of lumping them all in the same boat here. And Uber, we're expecting potentially an S1 filing any day now. What's the latest on that?
Right, on Uber any day now, this month, in the roadshow, could get underway this month. So the unicorn IPOs are moving very quickly. And I think, Pinterest is a very different company than Uber and Lyft. And so when you're thinking about what it's worth, Snap is a much better comparison. But I think why we're talking about all these companies at the same time is because there's been this question of whether the private markets were rational or whether they were overpricing all these private companies. And I think that's why this conversation around whether Pinterest was worth $12 billion and now it might be worth $9 billion is really interesting. And with Lyft, we saw the company go out way above its private valuation price. So I think this process of figuring out how the public markets feel about all these private valuations is ongoing, and it's a fascinating business story. And I think that's just why we're talking about all these companies at the same time while they sort of race out the door.
Right, you're nodding your head. Why?
Well, I mean, we're not sure what's going to happen after Uber files. I mean, if Uber raises, say, 10 to 15, some say as much as $20 billion, it could have the effect of kind of pulling the oxygen out of the room. I mean, we haven't seen a deal that big since Alibaba. So I think anybody who doesn't go before Uber, we have to wait and see what the market looks like after Uber gets its deal done.
What are some other interesting prospects you're watching? Zoom is one we haven't talked as much about, but could be a $10 billion company at the end of this.
So Zoom scored really highly with us. I mean, we think it's interesting that Pinterest is getting so much more attention than Zoom is. I mean, Zoom, we joke that Zoom has three things that we almost never see in a company filing to go public in tech land. EPS. So we just don't normally see the kind of growth and profitability that you see in a company like that. So it should probably get more attention than it's getting right now in the comparison with Lyft on the one hand and Pinterest on the other. As far as the bench of IPOs, the names are all kind of the shop-worn names now. We're waiting for Slack, which might not even do a real IPO. We're waiting for Peloton. We're waiting for maybe Palantir and a few others. But the expectation that there's a very deep bench, I think, could lead to disappointment.
Quite a crowded pipeline. Okay, Triton Research CEO Rhett Wallace and Bloomberg Tech's own Eric Newcomer. Thank you both.
Thank you.
Well, Tesla followed a disappointing deliveries report by cutting another swath of sales staff across the country as the electric car maker continues to pare back personnel and shift its ordering process online. The company dismissed several dozen sales team members across the United States. Those cuts made last week affected teams known internally as, quote, inside sales, which were tasked with reaching out to potential customers and inviting them to test drive cars. Coming up, social media companies have asked international governments to take the lead on regulating the internet, and the UK is planning to do just that. We will discuss possible new laws next. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Not content to sit around and wait for social media companies to regulate themselves, the UK is proposing its own new laws. If companies like Facebook, Google, and Twitter fail to, say, prevent the live streaming of a mass shooting, they could face fines and bans. That could even include imposing penalties on individual company executives. Jeremy Wright, the UK Secretary of State for Digital Culture and Sport, discussed the new proposals with our own David Weston and Alex Steele on Monday.
If you take as an example and as a comparator, the Information Commissioner's Office in the UK has the power to fine those who are in breach of the privacy and data protection regulations and would have the power to impose fines up to 4% of the global turnover of the company concerned. Those are very substantial fines. We think something of that order may be appropriate here too.
Those are potentially very substantial fines. We had Mark Zuckerberg of Facebook come out and say, we think that it's time to have sort of an internationally coordinated regulation. Have you spoken, or has your organization spoken with people like Mr. Zuckerberg or his representatives? Is this consistent with what they're looking for?
Well, I have spoken to Mr. Zuckerberg, and we've discussed exactly what it is the British government is proposing to do, and that I don't believe, and I don't think he does either, that we'll be the only government in the world to do this. I think that there's an acceptance on his part and the part of many other companies like Facebook that some form of regulation is now inevitable, and that they recognise that government should play a part in this. But it is important that the decisions are made by an independent regulator, and that that regulator is able to assess the systems that companies like Facebook put in place to keep their users safe. If they do what they should, then the regulator will be satisfied. If they don't, then the regulator will have penalties available to it.
So have you had any sort of concerns about tit for tat? I mean, if you're going to wind up having to issue these kind of penalties on U.S. companies, I can't imagine the U.S. is going to sit by and feel okay about that. What if they sort of do the same thing to countries operating in the U.S.?
Well, I think it's companies, wherever they are located, that will be subject to these rules. From our perspective, it's most important for us to keep the citizens of the UK safe. So those who are offering services to citizens in the UK will be subject to these rules. But we very much hope that we won't be the only country that will put in place measures like this. I'm confident that legislators in the United States will be subject to the same pressures we are subject to from those we represent, saying we want to feel safer online. We want our kids to feel safer online, and we want to deal with some of the very harmful online content that at the moment we don't feel is being controlled, when it would be controlled in almost any other environment. So I think this is something that's coming everywhere, and we want to set out what we propose to do, and I hope very much that others will be interested in what we're doing.
How do we strike the balance between keeping people safe on the one hand and actually curtailing speech that may be uncomfortable but actually is good for society?
Yeah, that is a difficult balance to strike, and one of the things that we will specifically require our regulator to do is to take full account of the protection of freedom of speech and also the need to promote innovation, because in the online space it's very important that businesses have the opportunity to innovate.
That was Jeremy Wright, UK Digital Culture, Media and Sport Secretary. To talk about all of this further, I want to bring in Bloomberg Tech's Global Executive Editor, Tom Giles. And with us here as well, RBC Capital Analyst Mark Mahaney, who currently has an outperform on Facebook. So, Mark, in the break we were talking about the Facebook pile-on. It seems they just can't get away from the bad news. How concerned are you about impending regulation of the content on these sites in particular, given they've demonstrated an incredible inability to regulate that themselves?
They may just have a technical challenge which no company can overcome. Same thing with YouTube and the quality, the questionable quality of content you've seen on that site.
Is it a technical challenge or a values challenge?
Well, it could be both. At least there's a technical element to it. There may be a values challenge to it. The fact that the CEO, the founder of Facebook, is asking for regulation may be a sign of maturity. Look, there are three major risks for these large platforms: Facebook, Google, and throw in Amazon too. It's competition, maturity, and regulation. And regulation has risen dramatically over the last 2 years. And in terms of the stocks, it probably puts a little bit of a cap on the multiple that they can sustain. There are going to be extra costs, and I think that's already in Facebook's numbers. That's what caused the company to materially lower its guidance about 3 quarters ago now. So this is going to be ongoing risk. I don't think it's existential, and I don't think some of the most extreme things we've seen about having them divest WhatsApp or having them divest Instagram, I think that's highly unlikely to happen. And there's possibly an advantage here that you're removing wild card regulatory risk by bringing in mainstream regulation. But
there's this new law that was very quickly passed in Australia in the aftermath of the Christchurch shooting, which would require these companies to pay up to 10% of their revenue if they violated the law. I mean, they're violating this law almost every day. I mean, there's hateful content up there all the time. Couldn't that be material to their business?
I guess it could be. I'd be surprised to see that actually implemented, but maybe it will be in one country. It's the risk. It's a global media platform. We've never seen anything of this size. One area of regulation we haven't talked about is just given the size of the company. Like Facebook accounts for about 90% of social media usage worldwide, ex-China, maybe 95% since they own Instagram. And so, yeah, it's going to be an issue, and they should be regulated. Whether that should be in a way that undermines the profitability of the business, that's the open question. Tom, you've been walking through the potential new laws. It's a little dense, but tell us what exactly these different countries are looking at here.
Yeah, it depends from country to country, right? Overall in Europe, you already have GDPR, right? So that subjects these companies to a potential 4% of overall revenue fine. You have the UK considering something extra that goes beyond that would punish these guys for failing to curb the kinds of content that we saw in the aftermath of the New Zealand shooting. You have France, just a digital tax. And so there's a lot of questions around exactly what that would look like. Would that be a percentage would that be taken away from the corporate tax they already have to pay in that country or in that region? Those things remain to be seen. But I think what's interesting here is, Mark Zuckerberg needs to be careful what he asks for. He talks about saying, hey, we're willing, we're ready, we need the regulation, we welcome it, we invite it. But what kind does that look like? I don't think what he and Sheryl Sandberg and Jack Dorsey are talking about is fine us, take our revenue, please. I think what they're asking for is help us come up with guidelines, help us come up with definitions that are going to help us navigate and set a standard for what's acceptable and what the repercussion should be when we fall short of that. I don't think they were talking about 4% and plus of our revenue intake.
Now, the backlash against these companies, and Facebook in particular, Mark, seems to only be getting stronger. New Zealand's Privacy Commissioner John Edwards tweeted overnight, Facebook cannot be trusted. They are morally bankrupt, pathological liars who enable genocide, in parentheses Myanmar, facilitate foreign undermining of democratic institutions. And he went on. He later deleted these tweets, saying that he then received a flood of what he called misinformation. And certainly you could quibble with certain portions of this statement, but there's a lot of anger out there, and it seems to be only getting worse. And how does that affect the company on a bottom line level? I'm
going to go out on a limb. I think the outrage is slowly ebbing, and I think you're seeing that in the U.S. If you go through, you had the midterm elections. There weren't issues in the midterm elections. We had those only 6 months ago. There weren't issues. I think if there were, I think the heat would be rising in this market, and they didn't. So you're going to have these one-off incidents. That kind of commentary seems to me a little bit. That seems to be a little bit over the top. I think the real surprise that Facebook faced was they didn't realize how aggressively their platform could be used. And it's not like it's not like they generated a lot of profits from Russians looking to manipulate the U.S. elections. And by the way, Facebook wasn't the only company that was surprised by international election interference. Apparently, so was the U.S. government, whose job it is to stop that kind of activity in the first place. So, look, I think there are technological challenges here. It is very hard when you've got live video to know what somebody is about to do, and you got to cap it off as quickly as you can. As far as we can tell, Facebook attempted to do that. It's always going to be a problem with anybody who's a very large media platform, a live media platform, whether it's Twitter, whether it's Facebook, whether it's YouTube. It's going to come with the territory.
That said, it's not just overseas. It's, in the U.S. itself, you've got U.S. lawmakers training their sites on Facebook. You've got Elizabeth Warren campaigning out there that Facebook and big tech need to be broken up. So, I mean, would you agree with Mark here, Tom, that here in the U.S. it seems like the outrage might be reaching a plateau?
I think that this is going to continue to be a bit of a political football throughout 2020, throughout the elections. I don't think it's going away completely. I think this does ratchet up the pressure on YouTube, Facebook, Twitter to do a better job of policing their platforms. It's important to remember that, hate speech and these kinds of these nefarious deeds did not originate with Facebook. This is not something that has just cropped up in the last 10 years since the creation of Facebook in Mark Zuckerberg's dorm room, right? But these companies do play a role in helping the speed at which this information and misinformation, hate speech, what have you, is disseminated. And they do need to, and I think they do accept a sense of responsibility for doing a better job of being a gatekeeper and keeping these, our worst impulses sort of in check.
All right, well, we'll certainly be watching to see how these new potential laws play out. Tom Giles, our global executive editor, thanks so much. Mark, you're sticking with me here to talk Snap. Still ahead, Snap extends its rebound after picking up another buy recommendation from RBC. Our continued conversation with Mark Mahaney is next. This is Bloomberg. Snap continued to rally on Monday with shares closing at its highest level since mid-August. That is in part due to picking up another buy recommendation from RBC Capital. Just last week, Snap announced a suite of new products and services, including a video game business. The stock now has six buy recommendations, 23 holds, and 9 sells. Still with us, Mark Mahaney of RBC Capital. So what makes you so optimistic about Snap?
Well, this actually does remain maybe the most controversial name in large cap internet. There's no deep consensus buy. Those ratings that you just mentioned, that skew is dramatically more bearish than you would find for name any stock you want. More bearish than Twitter, obviously more than Facebook. So I thought that was interesting. And what we think is happening is at least three things. The popularity of this asset, although the stock's been extremely volatile, the popularity of this asset hasn't changed. If you look at the most downloaded apps around the world in multiple markets, Snap is one of the top 5 most downloaded apps in multiple markets, and that hasn't changed. Second thing is they've had an Android problem. This is an app that requires full integration with the actual device itself, because when you open up Snap, you don't open up the app, you open up your camera. And so it has to be well integrated into the device. That wasn't the case. It took them 2 years to get this right. It's possible that they finally got it right, in which case you could see a real nice acceleration in DAU growth. And the third reason that we like the stock and we're stepping in here, I know the stock's up 100% year to date. It's off 70% since its IPO price. It's off 85% since its all-time high. So there's still sentiment here is very negative. But the third thing is the announcement of these games. And I think the bringing gamification of Snap can boost engagement to levels we have not seen before.
I have the Snap chart up on my terminal here, and you can see the rise since December. But you also think user growth could re-accelerate?
We haven't seen that yet. So the story of 2018 was user growth stagnated. They had no growth in DAUs from December of 2017 to December of 2018. So they've gone X growth in terms of users. That's why the stock corrected as much as it did 2 years in a row. This was the worst performing large cap internet stock for 2 years in a row. Now, if they truly have fixed their Android problem, you're going to open up a much broader range of users. You start seeing DAU growth return, you'll see revenue growth accelerate, you'll see gross margins accelerate, losses will come down, stock will go higher.
What about the Kylie Jenner effect and, the day that she tweeted, does anyone still use Snap anymore? Sad, as in I don't. Is Snap still cool?
185 million daily average users. It has got something like 70% more daily average users in the U.S. than Twitter does. And it's a utility. It's not a status as a service. It's not. It's a tool that people use to communicate, first and foremost, to communicate with each other. So if you're a communications tool, that means you are necessary for people who are on the platform. Now the question is, can you broaden the demographic appeal of Snap, make it more useful for people who are over the age of 17?
Are you pointing at me?
You need to make the site more intuitive, and you need to increase the functionality of the site. More media, more entertainment, more games, check. They just did that.
So why are you so excited about the gaming aspect here?
I think we're seeing a broad trend of gaming leaving away from sophisticated, maybe clunky console devices and coming right into apps, right into the internet user interface. That's what Google is doing with Stadia. I think that's what Snap's doing here. And we spent a lot of time playing with the games last week. It was fun. And it looks to us like these are natural activities that people who are on Snap would want to do.
All right, Mark
I've tested it with my teenage sons.
I was going to say, you're channeling your inner 17-year-old. Okay, RBC's Mark Mahaney, always good to have you here. We'll be watching to see if you are right. Thank you. Coming up, a Chinese woman who breached security at President Trump's Mar-a-Lago resort had a stash of tech and electronics on her, most likely in order to gain U.S. intelligence. We will have reaction from a former top U.S. cyber diplomat. And later, veteran tech investor Roger McNamee weighs in on the recent tech IPO craze. That is next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Let's return to our top story. Pinterest keeping the interest in tech IPOs going. The social media discovery company will offer 75 million shares at $15 to $17 a piece, which would value Pinterest at about $9 billion at the top of the range. But is investor interest in the newest crop of tech IPOs justified? Roger McNamee, Elevation Partners co-founder, joined BNN Bloomberg to discuss. Take a listen.
When I look at Pinterest, I look at them and going, they're doing a strategic thing on the IPO. You give people a sense it's going to be a super bargain, right? Way below the last round. But let's see where it actually gets done, right? This is to lure people in, to have them take a close look. Because Pinterest has a real business model, right? They were above break even in the fourth quarter. You know, it's not a huge company, but the market itself is quite compelling. You know, you have to worry about competition from Facebook long run, but these guys, they're advertising that they're the safe site, right? And that Facebook obviously is not, right? So you know, to me, these guys are being really smart about how they're doing it.
At the end of the day, we'll forget about the IPO itself.
Right.
A couple days, you know, certainly a couple of weeks after it happens, which does raise the bigger question, whether it's Lyft or Pinterest or Uber, they're all coming to market right now.
They are, and they're going to suck up a ton of capital because these are not fly-by-night companies. Not all of them have viable business models, but they all have a lot of scale. And they're going to take a ton of capital out of the market, and they're obviously going to generate a lot of enthusiasm because these are, relatively speaking, hot with consumers, right? Because they're all consumer companies. And to me, you know, with an inverted yield curve, with all the other issues we see in the economy, things slowing down, right, in the U.S. in particular, you know, if you're going to end a market cycle, a nice IPO blow-off would be, you know, at least historically consistent with experience.
Does this signal that the private markets are tapped out? I mean, these companies were able to stay private for so long that a lot of the growth was captured in the hands of private investors. Are you saying that the public investors are going to be the ones left holding the bag?
Well, I mean, the public investor is always left holding the bag. But in this case, the private investor is also still holding some bags because many of them invested at these high valuations. And these IPOs are not going to make them a huge return. They're going to need these businesses to work in the long run. I think the really core issue in the private market is the next generation. That if you look at it, Google in particular, but also Facebook, Amazon, are blocking startups in their competitive spheres. And as a consequence, we've had way too little investment in the next generation of the internet, and I'm really deeply troubled by that. And so I'm looking, we'll talk about that later, but I'm looking for some kind of intervention to try to make sure that, for example, in artificial intelligence, it's insane that 4 companies now have like 80% of the artificial intelligence talent. And what I worry about here is that there is this blank space behind these guys that's filled with only scooter companies and crypto companies and services your parents used to provide for you. That, you know, from an IPO point of view, they may be perfectly good businesses, but they don't have the kind of future market opportunity that a Pinterest might have.
Roger McNamee there of Elevation Partners with BNN Bloomberg. Now, court documents reveal new details following the arrest of a Chinese woman after she gained access to the reception area of the Mar-a-Lago club last month. Authorities found she was carrying 2 passports and a thumb drive containing malicious software. They also found 5 cell phones, 9 USB drives, 5 SIM cards, and a radio frequency device that detects hidden cameras on her or her hotel room. This comes as President Trump dismissed Kirstjen Nielsen as Homeland Security Secretary, which could have a large impact on the state of cybersecurity in the United States. For more, I want to bring in Chris Painter. He has served as the cybersecurity coordinator for the U.S. State Department and is currently a fellow at Stanford Center for International Security and Cooperation. Now, Chris, the lawyer for this woman says there's no evidence that she was spying. She hasn't been charged with spying. But when someone has that much advanced equipment on them, what do you think?
Well, obviously, we have to see where this goes. And as a former prosecutor myself, we want to see where the evidence leads. But why was she there with literally a bag full of cell phones and these USB drives? And another thing I saw today is from the affidavit that the Secret Service agents said that they not only saw malware on one of the thumb drives, meaning malicious computer code, but when he plugged it into his laptop, and why he did that, God only knows, it started downloading code into his laptop. So that certainly indicates an intent to do something. I doubt she was there to go swimming. I doubt she was there to install 5G, maybe at Mar-a-Lago. I think she was clearly there for some surreptitious purpose, and it's very troubling.
Right, and she said she was there to use the pool, but then authorities checked her statement, and whatever event she said she was there for didn't actually exist. In theory, how vulnerable would you say Mar-a-Lago is?
Well, and generally if someone goes to swim, you'd expect them to bring a swimming trunk and not 5 cell phones. I'm not sure how you wear those when you go swimming. Look, I think that really indicates a huge vulnerability. It is essentially, for all purposes, the Southern White House, and the security should be very strong there. And yet you have this person who knows who she is, but was able to get in pretty deep before she was finally discovered. And what we don't know is was this the first time this happened? Were not just, other folks from China, but from other intelligence services, if she was indeed from an intelligence service or from a company or from somewhere else, penetrating Mar-a-Lago and being able to really affect the security, including the electronic security. That is incredibly troubling.
Well, and exactly, that was my next question. I mean, the threat certainly isn't just from China. It's kind of from anyone, right?
Yeah, certainly. I mean, there isn't. It's hard to imagine a country, especially an adversary country or a potential adversary country, who would not want to get U.S. secrets and intelligence, and that is a prime target. It's a really, it's the mother lode in terms of intelligence. And if you can get something in there, and you can get either listening devices or into the computer networks, that's exactly what a foreign intelligence network or even a company who's trying to do gather intelligence, a foreign company or other, would want to do. And so it's an attractive target, and we need to protect it. And the fact that this is happening is something that's incredibly problematic.
Meantime, you've got the Homeland Security Secretary resigning as we are barreling toward a 2020 election, which is no doubt going to be threatened by the Russians in one way or another. Yep. And, the cybersecurity threats are ongoing, as far as we can tell. Does that place the U.S. in a particularly vulnerable position right now?
It absolutely does. I mean, we've heard from the Director of National Intelligence and really from the entire intelligence community that Russia is continuing to target our election, continuing to try to undermine our democratic systems, and they're doing this around the world too. And we need to step up to make sure we're doing everything we can to protect those systems. It is true that DHS and the FBI and others have done some good work, and there's some certainly good people at DHS that are working at an even senior level. But when you remove the leadership of an organization, and that leadership has cybersecurity experience and also has made cybersecurity a priority, that's troubling because without that leadership there, who knows what will happen? Will the resources be directed to this operation, to this priority? Will this indeed even be a priority given all the other priorities that DHS has? You couple that with the fact that the Trump administration got rid of the cybersecurity coordinator in the White House, and it really shows that perhaps this issue is not a priority for this administration. When if I look at the entire time I've been involved in cyber issues for like 27 years now, there is no time when it's more important for us to take this seriously and to do all we can to protect our systems, our networks, and in fact our elections from these threats.
Now, her acting successor is U.S. Customs and Border Protection Commissioner Kevin McAleenan, who doesn't have any substantial background in this field. Give us a sense of what the Homeland Security Secretary would be doing, on any given day when it comes to cybersecurity, and, what that job involves to sort of stem, threats that the U.S. is getting on a daily basis.
Well, I think that, again, at that level, at the cabinet level, it's showing leadership and really making sure that people understand why this is such a serious problem. We're still faced with a situation where people think of cybersecurity as this boutique issue or this bright, shiny object, when it's really a core issue of our national security and our economic security. And you need someone at that level to not only be the champion of that nationally, but also be the champion of that within the cabinet and with the president, to say this is a key factor. Now, this person who's coming in to replace her without any experience, you're a prisoner of your perspective. And likely, the perspective is going to be immigration, that's their background, and customs, that's their background, and they're going to push on that and not really understand the importance. It's one thing to be told that something is important. It's another thing to understand it and to having lived it. And I think that's what we really need. We need more people who can really show that leadership at a cabinet level and at a presidential level where it's clear this is not just another priority or not just something that's a sidelined issue, but one that's core to our national security.
All right, Chris Painter, former cyber coordinator for the U.S. State Department, thank you so much for weighing in. Meantime, Twitter is changing the number of accounts that users can follow each day from 1,000 to 400. The reason? Pretty straightforward. Those who have a high volume of following and unfollowing activity are usually spammers and bots. Coming up, Disney may be one of the world's biggest brands, but can it compete with the likes of Netflix? What is in store for the upcoming Disney Plus streaming service next? This is Bloomberg. Shares of video streaming platform Roku fell after its fourth downgrade in the last month. This time it was Citi, the bank cutting its rating on Roku from neutral to sell. Analysts say the video streaming platform is facing competition from both Amazon and Apple. Well, Disney is expected to show off its highly anticipated Disney Plus streaming platform on Thursday, giving investors a first look at its Netflix rival. The service will include original movies and TV shows from brands like Marvel and Pixar, and is scheduled to debut later this year. But there are still many questions surrounding the platform and its ability to compete in a crowded streaming space. Joining us from New York to discuss, BTIG analyst Richard Greenfield and Bloomberg's Paul Sweeney. So, Rich, how optimistic are you about Disney Plus and how well it'll be able to take on Netflix?
Well, look, I think the way to start off is you really can't frame the debate as Disney versus Netflix, right? I mean, Disney is going at this from a much lesser ambitious standpoint than Netflix. You know, Disney's not taking its movies out of movie theaters and putting them right onto the streaming service. So when Avengers Endgame comes out, it's going to be in the movie theaters. You're going to be able to go see it for months in the movie theaters, and then you're going to be able to buy it on DVD or download it on iTunes or buy it or rent it at a Redbox. And then eventually it's going to get 7 or 8 months after it's come out in the movie theaters, it will get to Disney Plus. But I don't think Disney's at the point where they're really going to go all in and put all of their content assets into the streaming service the way Netflix does. I think Disney's going to try to balance its legacy businesses and profit centers with kind of starting off into the streaming world. So this really isn't, I know it's been framed as Disney versus Netflix. This is really Disney adding a streaming service. Netflix is going to be the core service you subscribe to, and there'll be some subset of people that also take Disney Plus, especially people with young kids and families.
Paul, what are we expecting this Disney service to actually include? Like, will all of these legacy titles like The Lion King and The Little Mermaid, will you be able to watch those for free if you pay, whatever the monthly fee is? Are you going to have to pay extra for even that?
Well, we'll have to see. That's certainly one of the things I think investors want to see Thursday is really what's going to be in the service, what the service is, the price point for the service is going to be, and what kind of investment they're going to make in original programming. So there's a lot of numbers around Disney Plus that investors want to get a better handle on. As it relates to the existing Disney content, arguably, it's some of the best content on the planet. Bob Iger's paid up a lot of money to buy, all the big studios like Pixar and Marvel and then Lucasfilms, and so he's going to get the benefit of that on a streaming service. But not all of that content's going to be available day one because Disney has licensed this content out to other distributors. So over time, most of that content will migrate back to Disney Plus. So one could argue it's certainly going to have very credible programming. The question is, relative to Netflix and maybe some of the other tech companies that are getting into the media business, will that be enough for Disney?
Now, Rich, talk to us about the addressable market here. This is a more family-friendly, kid-friendly market that they are hoping to reach, which, and I know it's not all about Netflix, is different from a Netflix market. How does that impact your outlook?
Well, I certainly don't think, I don't think a couple is going to come home on a Friday night and say, I want a Disney Plus and chill. I mean, I think that's going to be probably a bridge too far. But I do think from the standpoint of, look, they're going at PG rated, and below, family friendly, no sex, no violence. This is going to be really Disney, which is going to be really limiting. You think about Netflix, they're already at 60 million subs domestically. I think the kind of broad consensus view is they're moving towards the 70 to 80 million subscriber range. Basically, essentially what the cable industry has been. They're simply replicating the cable universe. This is going to be some subset. There's probably 30 million plus homes with kids under the age of 18. You've got some incremental fanboys and fangirls who love these franchises like Lucas and Marvel. Probably somewhere in the 30 to 40 million domestically. And, that's why I think there's been this view from consumers that there's this massive opportunity, and I think you've got to size what Disney's trying to do. They're not trying to create a service for everyone. They're trying to create a family service for Disney Plus, a kind of ESPN add-on service in ESPN Plus. Then there's Hulu, which is going after sort of this adult/family market, because even though they're saying it's more adult, most of the content on Hulu is pretty family friendly, like it's last night's television from broadcast TV. And so I think what we're overall looking for on Thursday is how is Disney going to explain what their streaming strategy is? And probably most importantly, like every viewer of this show should be thinking about for Thursday, how does Disney continue to tell people to pay more for Disney Channel, pay more for ESPN, when they're literally going out with products and services that are away from the bundle, that actually kind of compete with the bundle? And how does that balancing work? Can they continue to get paid a couple dollars a month for Disney Channel, $8 or $9 for ESPN, while they go and attack the bundle through these new over-the-top services, which Iger has said very publicly is company's #1 priority now?
Right, and meantime, they're going to be losing licensing fees they currently get from companies like Netflix. Do we have any quantification, Paul, on how much Disney could be losing?
Yeah, this is a big number. This is, north of $1 billion when you think about the investment that they're going to be making in original programming, plus the lost fee revenue that they're getting from the Netflix of the world today and from other distributors. So, this is a major pivot for the Walt Disney Company here, and it's all on Bob Iger's name right here. This is his legacy right here as he tries to pivot the company away from what was the traditional cable bundle, which had been so good to Disney for such a long period of time, now pivoting to the streaming service. But because I think the clear issue from Bob Iger's mind is he knows that's where his audience is going, and he has to be a credible player there.
So, look, Rich, there's a lot of excitement about this, but are you concerned that Disney could be almost cannibalizing itself here?
Look, being an arms dealer is a great business. I mean, the media industry has been an arms dealer forever, right? I mean, these are studios, content studios that sold to movie theaters, sold to the HBOs, sold to the Netflixes, the Amazons. There's more buyers than ever before. Trying to go in and do something you've never done, which is build a direct-to-consumer company. I mean, Disney doesn't know who the three of us are. They don't have what Emily's used to watch. They don't know what Paul watches. They don't know what Rich Greenfield watches. They don't know anything. They don't know that you go to the movie theater. So going in and trying to launch a direct-to-consumer streaming service is really hard. I mean, you look at the amount Netflix loses and how much they're investing in the... Remember, it's not just content. I mean, Netflix's marketing budget is $2.5 billion a year. Their technology spend is a couple of $2 billion a year. I mean, this is a very, very expensive endeavor to do and replicate. What I struggle with is why Disney feels the need to do this versus being an arms dealer of this incredible content to every single streaming platform out there. That seems to be the real challenge, is can they actually justify what they're going to spend, how many subs they're going to get, versus remaining an arms dealer, which has been an incredibly profitable business for decades. This is not just for Disney. You could say the same thing about AT&T Time Warner with their new strategy for Warner Media Group.
All right, well, it's certainly a provocative metaphor. We will be reading the fine print on Thursday when Disney unveils this. Rich Greenfield of BTIG, always good to have you, along with Bloomberg's Paul Sweeney. Still ahead, ride-sharing is off the ground. How startups like Jet Suite X are also changing the way we fly. This is Bloomberg. With a touch of an app, you can get a ride in a car or on a scooter. Well, now you can also take to the skies. Private flights were once reserved only for the rich and famous, but now all you need is a smartphone to hitch a ride with one of these aviation startups.
Imagine you want to take a quick flight for business. Instead of shuffling through long security lines and navigating huge terminals to board a crowded commercial airline, you can instead opt for the private flight experience, all with a touch of an app. Blackbird and Jet Suite X are two startups in a flock of companies pushing the private flight industry forward.
We think of ourselves kind of in the same vein as the on-demand transportation companies like Bird, like Uber, like Lyft. We just are the journey that's a little bit further.
Blackbird offers flights in small aircrafts, and the company is focused on the 50 to 500-mile journey. It recently announced a $10 million funding round backed by New Enterprise Associates.
Aircraft today are really only utilized roughly 1% to 2%. It's a highly underutilized asset, and it's an expensive asset. So when you can actually start to amortize that cost basis over a lot of rides and also enable a lot of pilots who want to fly a tremendous amount more, you really create a flywheel of increasing adoption.
Jet Suite X, a Silicon Valley unicorn valued at $1.5 billion, advertises semi-private flying with not-so-private fares. The company utilizes larger jets and pairs passengers together, offering flights between short-range destinations. Other private aviation companies, such as Jetly, offer the private flight experience by putting passengers on empty legs of private jets.
What I see from the space is a lot of technology-minded people who think that with the right algorithm, you can make money from the inefficiencies in private aviation. You've got big players in the industry. For all intents and purposes, they are operating airlines, whether they're scheduled or charter.
Like established commercial airliner Delta, offering full-priced private flights as well as discounted empty leg flights.
On the other side of it, you've got the technology component of the non-aviation crowd. And that's not to say that this is not a business that can grow by leaps and bounds and there's not huge opportunities. It's just that I think to date we have not seen the regulatory regime keep up with a lot of the tech innovation.
FAA guidance forbids private pilots from profiting from flight sharing and even shut down the flight sharing services Airpooler and Flight Now in 2014. But Blackbird's pilots are commercially certified and own their own planes, keeping the startup's cost low while meeting FAA regulation. The charter flight industry in the U.S. has grown by 2.6% in the last 5 years to reach revenue of $25 billion, and tech startups want a slice of that market.
Smart speaker maker Sonos and furniture retailer IKEA are teaming up, and the two announced their first joint products Monday, including a bookshelf speaker and table lamp speaker, both controllable through the Sonos app and can be integrated as part of a multi-room audio setup to control. The Sonos and IKEA partnership began in March 2016 as part of IKEA's Smart Home Initiative. Visit to IKEA just got a little more interesting. That does it for this edition of Bloomberg Technology. Tomorrow we're going to hear from Marcelo Claure, the COO of SoftBank, who will talk about the company's $2 billion commitment to invest in tech in Central and South America. This is Bloomberg.